Hi, greetings everyone. Here you can see our new offices. They're almost finished here in St. Pete. We're really excited to be moving into these new offices. It's been kind of crammed, so welcome. This month's video is called Defanged, and I think what is happening here is many investors, both growth and value, are beginning to understand the world of disruption out there. Even the FANGs are being disrupted. Many growth managers think they have the right kind of exposure to innovation in the form of the FANGs, or they did at the beginning of this year. And much of that kind of thinking has disappeared here. And so what I will do later in this call is talk a little bit about what this means and how it is distinguished from the kinds of strategies we're involved in. The FANGs became the biggest parts of the benchmarks, like the S&P and the NASDAQ, especially the NASDAQ 100. And again, that was very backwards looking. Those stocks rose to the top because of past success. And then TikTok came along and talk about disruption. And then a recession comes along, as exemplified by the advertising crash that is taking place and hurting many of these companies. And we're seeing layoffs and freezes, something we've never seen from these companies. But that's distinguished from the kind of innovation in our strategies. We are very early stage, and while our stocks may have suffered as much as the FANGs have, certain of the FANGs have, what we're seeing right now is very early stage growth. So we can talk about that in a little while. I just wanted to set that up. It has been one heck of a rough time for innovation of all kinds in the last 18 months. But if we are right, and of course we could be wrong, but if we're right, truly disruptive innovation is going to move into a growth trajectory that we believe will make what has happened recently to their stocks look like a blip in hindsight, given the great strides ahead. So that's distinct from the kind of disruption that's taking place and causing some trouble for tried and true, the stocks that have become big parts of benchmarks. So that's just a prelude to set up for this call. Now I will go through in the typical order: fiscal policy, monetary policy, economic indicators, and market indicators, with a few last words about innovation at the end. So on fiscal policy, well, the midterms are upon us next week. And if the polls are correct, it does look like there will be a shift back to conservatives in certainly the House, but perhaps even the Senate. And we think that the stance of many conservatives is to push back on excessive regulation. Regulation can be an innovation killer. So that will be good news. And we think there will be other innovation-friendly moves in terms of incentives and so forth. What's interesting about this election and this period in time is historically, and this is just history, this is, believe me, not at all partisan, it's just observing. Historically, the market has done better under Democratic administrations. And the conservatives would tell you, well, that's because we would have to come in and clean up all of the excesses, the excess spending, the excess monetary stimulus. And that would mean a crackdown on certain businesses which would be bad for the market and bad for psychology. Seems like it's the opposite here. I have never seen fiscal outlays, federal outlays, down at a double-digit rate in a midterm election year or a national election year, and yet here we are, down year over year, and I have never seen monetary restraint, the likes of which we're seeing now, in a midterm election year. In fact, historically, during election years, midterm or the national elections, we saw Federal Reserves basically saying to themselves, perhaps, but it seemed like we observed their actions to be, okay, get all of what we need to do out early in the year so that we're not accused of being political. And that has not happened this time. In fact, at the time in past Fed regimes, that they would be basically going neutral, just status quo, that probably would have been around February, March of this year. And yet that is when the Fed really started to crank up interest rates at a rate we have never seen historically. Never. We have never seen this. Many people equate what happened during Volcker's years as similar. Volcker was really trying to throttle inflation and raised interest rates from roughly 10% to roughly 20%. That's a twofold increase. With this week's action from the Fed, another 75 basis points, the Fed has taken interest rates up 16-fold in less than a year. Never been done before. And I think we're going to see the fallout during the next year. And when I say that, I mean it will be a cyclical fallout. And I think it will benefit those companies that can grow through this period. And as we said all during COVID, innovation solves problems. We have so many more problems now. Supply chains loosening up, but still we have the war in Ukraine. And now we have fiscal and monetary policy really tightening in a way that businesses are going to have to change the way they do things, increase productivity, cut costs, and so forth, in order to navigate through this very difficult environment. We think that will accrue ultimately to those companies who facilitate those kinds of productivity moves, cost controls, and so forth. Now, in terms of monetary policy itself, this last month, I did write an open letter to the Fed, just for one reason. It was to say, wait a minute, there are 12 members voting here, and you've been unanimous over the last few Fed decision points. Unanimous, 12 of you. How can this be? There's so much conflicting evidence out there. And I put into the letter some of the conflicting evidence, primarily the early stage of the pipeline from an innovation point of view, commodities falling dramatically, and we'll get to that in a moment. And the fact that inventories are overwhelming the system. And I think we'll see that in terms of huge discounts at Christmas. Even the Fed's own, that there are regional territories where the Fed engages with business leaders. There are 12 of them. Even these, I know they're not called territories, I think they're called banks, are showing in their monthly indicators. So the Empire Fed puts one out, the Philly Fed, Richmond, Kansas City, Dallas. And these are quantitative indicators. They may be subjective surveys, but they are subjective all the way along. And they are hitting the skids one by one, negative territory, negative. I looked through the last month's worth, and all of the banks that I just mentioned were showing increasingly negative sentiment about economic activity in their regions. And prices actually falling, and we did see that in the Purchasing Managers Index. Prices paid index showed negative prices, and again, we'll get into that in a minute. So money now, M2 growth peaked at 27% in mid-2020, and as of September was down to 2.6%. It looks like October could be below 2%, maybe 1.5%. And effectively, money is falling. Money, if you look sequentially, is falling. Now, the only time we've had a sustained decline in money on a year-over-year basis, again, we're not negative year-over-year yet, but that's where we're heading, was during the Great Depression. And hold that thought, because I'm going to describe why we're not in the environment that the Fed thinks we are, which is the 70s. And the reason is, I think I set this up in the last YouTube video. In the 70s, when Volcker inherited a very bad inflationary situation, so inflation was moving into the high single digits, low double digits, mid double digits is where it peaked. So he inherited that, but it had taken 15 years for that inflation to move to those levels. Now, it started in April and May of 1964, Vietnam War, Great Society programs, the Johnson administration putting into place many social programs at once. And it was a period called guns and butter, so spend on everything, which they did. So we had fiscal policy moving really out of control, and monetary policy accommodating it. And also, as we went off the gold exchange standard in 1971, we closed the gold window. That was the last semblance of discipline in our monetary policy. That was 1971, as I said. You know, all hell broke loose. We had OPEC quadrupling oil prices. We had the Fed accommodating those oil prices, which eventually got into all kinds of indicators, including wages. And you'll often hear the expression cost push inflation. It comes from the 70s. The cost push was wages pushing through. And I think this time is very different. Then you had Volcker, as I mentioned, going from 10 to 20%. So twofold interest rates. And that did the job. This period is not 15 years. By the time the Fed started addressing it, it was 15 months. So we didn't have a lot of time for inflation to get out of control. And the inflation that we were talking about this time is not the monetary-driven inflation. It was a supply shock to the system. So the supply chain imbalances, which I never thought would last for 2 years, still puzzling over that one, that was a real problem, a supply shock, a shock to the system. So if the supply's not there, but the demand is because of all of the stimulus, then what happens? Demand up relative to supply means prices go up. They go up until the supply meets the demand. Now we're moving into that part of the story. And I think we'll see it in action, in dramatic action this holiday season, as retailers who are just brimming with inventories, trying to figure out what to do, are forced to slash prices. And we're already seeing 20, 30, 50% discounts if you go to Walmart, and I'm surprised to see it at Walmart. I thought that was everyday low prices, Target, and other places. The other thing that's very different about this period relative to the 70s is the dollar has been moving up In the 70s, the dollar was moving down. In fact, we ended up in a dollar crisis in 1978. And I believe that's one of the reasons that President Carter basically got rid of Miller, that Fed chairman, and brought in Chairman Volcker. And that was a terrific move. Now, the dollar in the early 80s started moving up dramatically, and it almost went parabolic and became a real problem for the world. Does that sound familiar? Here we are again. The dollar going up is a massive deflationary force. And it's deflationary because commodities are priced in dollars, the reserve currency. It's deflationary because emerging markets have a lot of dollar-denominated debt. Their currencies are falling apart, but they have to service their debt in dollars. So it's a real killer. And so that is happening now. And you'll notice that a lot of banks around the world are starting to move against the Fed. They had been aligned with the Fed, but the BOE, Bank of England, because of the liability-driven investment debacle, which brought down trusts, the BOE had to step back and say, no, we're here to support. This is a near Lehman moment. We must support our banks because if these pension funds cannot meet margin calls, then the banks, which were the other side of the swap trade, would be left holding the bag. And so the BOE has pulled back, maybe not verbally, but in action. You've got the BOJ, so Japan, PBOC, both supporting their currencies, which means what are they doing? They're selling dollars and buying their currencies. That's adding dollar liquidity to the system. And we saw Australia this past week increasing its interest rate only 25 basis points. And so you've got the central banks basically saying, oh, wait a minute, what's going on here? Australia would be very sensitive to commodity prices. And in a moment, I'll give you a sense of the drama that's going on in terms of commodity price inflation or deflation, which of course is the early stage of the pipeline for inflation in final demand indicators. Okay, so let's go to two other periods in history. So we don't think this is the 70s. What could this be? All right, looking back in history, there are two periods that remind us of what we're going through right now. One is really 1918 through 21. And so that was a period of war, World War I, coming to an end. And so World War I and the flu, the Spanish flu, which was much more vicious than COVID-19, killed as a percentage of the population, a much greater percentage of the global population. So war and flu, again, sounds familiar. And we were in the middle of one of the greatest innovation booms in history. Telephone, electricity, automobile, transformational, truly disruptive. Sort of sounds like today, right? Okay, so from when we were experiencing the supply shocks associated with both the war, which was a very long, well, we haven't been through nearly as long a war as they went through then, and then the Spanish flu. The Dow Jones Industrial Average from November of 19 to August of 21 went down 46%. Inflation associated with these problems, again, mostly supply chain, I would submit, inflation hit 15 to 25%. It was in that range for a while. Again, that war was longer, the flu was longer. It certainly took a much longer time to unwind than ours has. So that was a very bad period. But that inflation within a year, again, it was a couple of years, the inflation, that inflation turned down and moved into deflation. I think the deflation was something like 15%. Yes, it was 15%. So that was June of 21. So it went from 24% of June of 20 to minus 16% of June 21. Now, I've been saying for quite some time that I think the bigger risk here is deflation. Now, it's a risk and an opportunity in a sense. The risk is on the cyclical side. It's the supply chains having been so out of balance that inventories were overwhelming. I believe that's what happened back then. And prices just fell very dramatically within a year. That would be cyclical, but it would also be secular, because telephone, electricity, and automobile were innovations following learning curves, and the costs associated with them were falling fairly dramatically. That's what we've been describing here. And what happened then? So starting in I think it was mid-21, we moved into the roaring 20s. So here we are again in the 20s, and we think they could be roaring 20s now. From mid-21 through September of 29, the Dow Jones compounded at an annual rate of 25% per year. So that would be the good news scenario. Now, there is a possibility that there's a bad news outcome here. If you look at 1929 to 30, there are also some similarities to where we are today. Monetary policy was tightening aggressively. Now, inflation was not a problem then. In fact, it was quite low. But the Fed was railing against financial speculation associated with the Roaring Twenties, and it made a mistake, because inflation, again, one of the main reasons the Fed is around, and really had just been created, was to solve for price stability, keep prices as stable as possible. So they were tightening, and it had nothing to do with price stability. I would submit that this time around, the Fed's not looking at commodity prices. It's not looking at inventories and how they're translating into discounts. They're looking at lagging indicators, employment and inflation, the headline numbers, and we'll go into that in a minute. The other thing that was going on back then, and this was in 1930, was Smoot-Hawley tariffs, broad-based tariffs, 20,000 goods, and the tariffs were in the 50% range. Well, we don't have quite that, but could this CHIPS Act, chips are in everything, and I realize it's just the higher end of the chip stack, but could this CHIP Act be a real impediment to growth? Could it be the equivalent of Smoot-Hawley? We don't think so, but one never knows. You know, history will tell us. Anyway, from September of 29 to July of 32, the stock market dropped 89%. Now, I mentioned with the earlier part, the early 20s, it went down 46% before we entered the Roaring 20s. This time it went down 89%. If you compare that to the tech and telecom bust from March of 2000 to November of 2002, we were down 78. If you look at innovation strategies like ours, like others, many of them are down 75% plus. And even the tried and true stocks, Meta, for example, is down 76% from its peak. Netflix, down 76% from its peak. Bitcoin is down 74% from its peak. Now, again, what's the difference between the first two, Meta and Netflix, and Bitcoin? The first two are very mature. They're not the new innovators anymore. In fact, they're being disrupted. Whereas Bitcoin is the disruptor, and I would submit those running real innovation strategies are more in this early stage group. And if you look at the history of Bitcoin, and you look at 2017, for example, in the context of what happened afterwards, it looks like a blip, and we think that will continue to be the case as Bitcoin continues to gain traction, and as innovation strategies continue to gain traction. I was asked this week in an interview whether how I could possibly feel with this kind of down round, and of course it never feels good. But because of our research and because of our 5-year investment time horizon, what is happening here is the rubber band is stretching, because if anything, the turmoil that we're in right now, economically and otherwise, is going to hasten the adoption of these new technologies. Now, it is true that some stocks in the innovation space are going to have some cyclical dynamics attached to them. Any company involved or associated with marketing and advertising or so forth is going to be singed in this environment. Roku's been very vocal about it, but if you look at Roku's statistics, the scattered advertising market, which is the primary advertising market it's focused on, was down 38%. And Roku's revenues were up 12%. Their platform revenues, so advertising, were up 15%. And one of the reasons is because they're becoming less reliant on the scatter market, which is the short-term advertising market that you can pull if a company is worried about saving their quarter or something. And Roku is now being dealt into the upfront market. It is becoming an important way to reach consumers, and consumer products companies know that. So now it's getting some of the more stable upfront market. And we think that will continue to be the case. Now, on to economics. Again, I mentioned that the Fed is focused on lagging indicators, employment and inflation. So let's deal with those directly. Today was Employment Friday, and we knew that the number was going to be positive. It was more positive. Non-farm payroll was more positive than expected. Initial unemployment claims had been pointing in that direction as well. So non-farm payroll employment was up 261,000, better than the expectation of 190-ish thousand. Average hourly earnings were up 0.4%, a little stronger than the 0.3%. Now, of course, the Fed is railing against this. The Fed wants the unemployment rate, it seems, to be at 4.5%. Well, we started to move up in terms of the unemployment rate. We went from 3.5 to 3.7, partly because the participation rate dropped a bit. So the Fed is getting its wish, I suppose. But you know what's interesting about this hypothesis? It's a Phillips curve, not hypothesis. I think it's been disproven. Phillips curve says, well, if you want to get inflation down, then you have to get activity down. The history of the 80s and 90s and even into the 2000s, if you look at it, is when real growth was strong, inflation was low. Why? Because of productivity. And I think that will continue to be the case. Nonetheless, that's what the Fed thinks. And so it's unfortunate, but we're probably going to see unemployment rising. And we're already getting some indicators. So here's the other side that the Fed isn't talking about that much. First, the Challenger Job Survey, it's a layoff survey, and it is showing a 48% increase in broad-based layoffs, meaning layoffs that companies are announcing that cut across divisions and involve quite a number of people. And we also saw that in the Purchasing Managers Index, again, leading indicator, that employment in that index went negative in this last month, October. Then, very importantly, in the employment report itself is buried a number called household employment. I don't know why they don't feature it more, the Fed in particular, because it's much broader based than a non-farm payroll survey. And it includes many more small and medium-sized businesses. It also includes people who are working 2 jobs or 3 jobs, and they'll just say that they're working. And it also includes what's called the birth and death rate of small businesses. And so that indicator, household employment, dropped 328,000. And if you look at it since March, it's been fluctuating, but since March, it's gone nowhere. Now, that's not the picture that non-farm payroll is painting here. But I trust this employment indicator much more than non-farm payroll because it's better at turning points in the market. So think about that. For more than half of a year, this measure of employment has gone nowhere. What we think has happened in terms of non-farm payroll, which is much more big company oriented, is that a lot of companies had so much trouble finding employees over the last 2 years that they're reluctant to let them go because economic indicators are suggesting they should let them go. And if companies become mismanaged enough, then we probably will have more Twitter-like examples where a new and visionary leader goes in and cleans house. And today, I guess, Twitter announced 50% of its workforce will be laid off. So I do think that many companies are going to have to take strong action here because of what the Fed is doing and because fiscal restraint, as measured by federal outlays, is so significant right now. The other lagging indicator the Fed is really focused on is inflation. Now, inflation, the downstream, closer to the consumer, is sticky, and it tends to be sticky at turning points. So we have the PPI still at 8.5% on a year-over-year basis, the CPI 8.2%, the personal consumption deflator 6.22%. But I'd like to share with you what's in the pipeline here in other metrics. Dear me, I have to find it because, yes, here we go. All right, so listen to this. Now I'm going to start with the highest price declines from their peaks, and these are as of October 31st when we did this report. So the Baltic Dry Freight Index, which really gives us a good sense of the rates, the shipping rates paid, they have dropped 74%. They peaked more than a year ago in October of 21, and they're down 74%. Lumber, May of 21 it peaked, it's down 73%. Iron ore, June of 21, it peaked, down 52%. DRAM prices, July of 21, down 51%. Silver, August of 2020, down 34%. Copper, March of this year, down 32%. Oil, March of this year, down 30%. Gold, August of 2020, down 21%, and corn, April of 22 this year, down 15%. Now, gold, interestingly, peaked more than 2 years ago and has broken down. It stayed in a 1,700 to nearly 2,100 range for 2 years, and it's broken down. Gold is a great leading indicator of inflation, and it was on an upward trajectory which has now completely turned around. Now, a lot of these indicators are down on a year-over-year basis as well. Baltic freight down 58%, lumber down 22%, DRAM down 36%, copper down 23%, silver 20%, gold even down 8%. You've still got oil up 4% and corn up 22%, but you can see the pipeline is full of deflation. And as we know, with the inventories, and we look at them month to month, they're still increasing. Again, those ships are coming. I think last month, I described Nike's inventory on ships on their way over to the United States, up 85% year over year. And their North American inventory is up 68% as of the end of the August quarter. Importantly, the saving rate has come down to 3.1%, which is kind of shocking. Before COVID, it was at 8%. It went up to 34%, I believe, at the peak, as the stimulus payments were working their way through. Now it's down to 3.1%. 3.1. And if you look at what the consumer is doing, consumers taking on more debt now. And so what that is telling us, contrary to those who think everyone has a nice little cash buffer because of all the stimulus, we don't agree with that at all. A lot of people getting those stimulus payments were hand to mouth. As soon as they got it, they spent it either to pay down debt or to buy food or energy. Now they're taking on debt probably to pay for food and energy. That's not good. And consumer sentiment, again, near record lows where they were, where the University of Michigan sentiment was in the early 80s. Another very provocative number recently has been home prices. If you look at the S&P CoreLogic price index, it fell month to month 1.3% in September. It peaked on a month-to-month basis, meaning sequentially, at 2.5% earlier this year. That is a massive reversal, and the fastest reversal that I have seen on record. Even in 08, 09, the reversal kind of started in 06, 05, 06 or something. So housing prices are now starting to come down, and we haven't seen a price decline that extreme, the 1.3, since the 08-09 period, when we were regularly at 2% declines per month. Now that the consumer will really feel as well, because again, the nest egg, home equity, is starting to come down. Okay, so now let's flip to the market. Year to date, the only thing that's worked is energy, up 65%. Ironically, there are two reasons. ESG, capital spending, shut down by a lot of companies in favor of dividends and share repurchases. I think that's going to change dramatically with the midterm elections. I think the spigots are going to be open and that production is going to boom to new highs here in the United States. And then the other two top performers, utilities and staples, both down 7 to 8%. And then on the negative side, we have year to date, comm services. Of course, the Meta was the poster child this year, down 44%. Consumer discretionary down 35%, tech down 32%. In the bond market, we're getting some indicators. We now have the yield curve down more than 50 basis points. And here's another case in point where I think people are saying, oh, but the base was so low, going up from 0.25% to 4% in the Fed funds rate. It's not a big deal. It is a big deal. In economics, activity is determined at the margin. You take a price up that dramatically, or a cost up that dramatically, 16-fold, there are going to be serious ramifications, and we think they're upon us. And advertising is the first category that businesses cut, and it's being demolished. So the markets are speaking quite loudly here. That 53 basis points on a 4% interest rates is a lot different from 50 basis points on 15%, which is what we saw in the early 80s, which is the last time we saw an inverted yield curve, this inverted. I think what's throwing people are spreads. So spreads, the difference between high yield bond yields and the treasury yields, they're moving up, but they're not skyrocketing. And I think a big part of that is energy bonds, and energy is a big user of debt because prices are still pretty elevated, and these companies are making tons of money. That their spreads are very narrow, and they're holding the broad-based aggregates down. So we think if you look beyond, or if you look at spreads beyond energy, you'll see some pretty significant gapping out, and that's a sign that there's some duress out there. Another indicator is credit default swaps. And I've been watching these, especially as they relate to money center banks. We know when it comes abroad to the banks, Credit Suisse, for example, blowing out to all-time highs. But Europe has very significant problems that we may not. The credit default swaps of our banks, so I keep track of Bank of America, Goldman Sachs, JP Morgan, and others. They've been gapping out. What's going on there? And I think what might be going on is uncertainty or concern about swaps, a little bit like what the LDI problem that the UK was forced to address. So very interested in that. I always ask our analysts to listen for questions about spreads on earnings calls, and they're not getting a lot of questions. So maybe we'll have to make some of our own phone calls there, even though we don't own any of these banks. And the other thing I'd like to say about markets is, and many people don't have this perspective, but we remember 08-09 because people were losing their homes, and it was tragic. But if you looked at stocks and bonds in the 08-09 period, what we saw was, in terms of wealth destruction, using both stocks and bonds, 21%. 7.5%. 7.5% back then, because bonds held up. This time around, bonds have not held up. We've had the worst bond markets since, I've mentioned this before, you have to go back into the 1700s to see year-to-date performance worse than this. And what we're experiencing, if you combine equities and bonds, is a 21% decline in wealth, real wealth destruction. And if you look at some of the surveys, University of Michigan's survey, and you separate high-income earners from low-income earners, high-income earners' sentiment is lower than the low-income earners, even though the food and energy price hits have been much more severe when it comes to the low income. Other markets, commodity prices I just gave you, is there any place to hide? I mentioned swaps being something we have in mind here. They may have worked very well for Blackstone's REIT product, but when I see swaps being used so significantly, I just want to learn more, shall I say. Now, the interesting thing about this environment is if you look at crypto. So Bitcoin has been incredibly stable since its June lows. In fact, the volatility, 30-day volatility of Bitcoin has dropped below the 30-day volatility of the S&P and the NASDAQ. And you'll see that in our Bitcoin Monthly. We're publishing it this evening. And there are some very provocative charts in there that are suggesting we're in a bottoming period for Bitcoin. Now, we do have to be careful. We've seen a nice base develop here. And as many of you might remember from our Tesla call in the day, I said, the base, whenever you have a very long base, and in the case of Tesla, it was 5 years, but whenever you have a very long base, something big is going to happen, because that's the bull and the bears dueling each other. In the case of Tesla, our bet was we'd have a big upside breakout, and we did. In the case of Bitcoin, we would expect the same. The base is not nearly as long, and a lot of the on-chain analytics are supporting that point of view. We're also going to be talking more about this in our market update next Tuesday. And in the next few weeks, you'll see 3 research papers, one on AI accelerators, one on the Bitcoin energy / utility ecosystem, pretty provocative, and one on how important, maybe the most important innovation in history will be autonomous mobility. So look for those papers from Frank Downing, Yassine Almandra, and Sam Corris, and Tasha Keeney. So with that, I'll leave you with this idea that, once again, that Bitcoin is an example of a very early stage innovation that we think has miles to go. And so this down round is in the early stages of early stage growth. The volatility is normal. But then again, when you look back historically, that volatility, which feels so awful at the time, turns into, looks like a blip if you look backwards. And we think that's a case with truly disruptive innovation around which we have revolved our strategies, as opposed to the FANGs, which are being disrupted. That's a completely different story, completely different. Now, we may share some of the cyclical fallout from advertising, but that's it. And I think we're going to separate the wheat from the chaff here in terms of truly disruptive innovation versus those being disrupted. So stay tuned, and we will look forward to sharing our insights with you over the next month, and I will be back next month. So thanks again.